This is Just Ask George, exploring the universe of corporate finance and capital formation for your business enterprise, with merchant banker George Lovato Jr. and your host, David Wolf. Welcome back to Just Ask George. David Wolf here with the infamous George Lovato Jr., the head dude, founder, entrepreneur, merchant banker, author, speaker, and thought leader in merchant banking.
God, you made me sound so good.
That's part of my gig, folks.
And I pay him $20 in lunch every Friday.
By the way, we're selling
nice.
Exactly 20. I will work for food. You know, I'm one of those guys out on the street. We're celebrating 2 million views on YouTube.
Thank you very much for watching out there.
So we appreciate you watching. We hope we're serving the entrepreneurs at large around corporate finance and capital formation. We were talking offline about a subject dear to George's heart. He's wearing red. We're celebrating post-Valentine's Day. We love what we do here. There's a reason we build businesses. There's a reason we form capital. And often we forget about that in the present because it's about a future event. Sometimes we call this the exit. So we've titled the show, Anatomy of an Exit Strategy.
There's kind of a rhythm to that. You know, there's a little rhyme to it.
Anatomy of an Exit Strategy. Yeah. And it's got even a little rhyme thing, almost a cheat rhyme, slant rhyme as they call it. So what is this thing called an exit, and how do you like to frame this out?
You know, some businesses are built for family succession. And we frequently run across the business that is in its 3rd, 4th, or 5th generation of being managed by a family member. And that definition of exit is different than the definition of exit where the individual is just desirous of selling the business out. And it comes up all the time. I mean, it'll come up in passing, or it'll really be an in-depth discussion as to what it is someone wants to do once they've built that profitable business, once they've grabbed the brass ring, once they've created a profitable entity that's sustainable. And I find that a lot of people's expectations about that exit strategy are very unrealistic.
You've said this. Yeah. There are realistic expectations, unrealistic expectations. You see a lot of the unrealistic type, I'm guessing, in your practice, right?
Yeah, you know, sometimes people are dramatically influenced by what they read on the internet.
Fancy that.
You know, just because, you know, the old adage, just because it's on the internet doesn't mean it's true or it's correct. But,
right.
But, you know, and then there's sort of the Hollywood kind of story. You know, we create dramatic storylines on Zuckerberg and, you know, the movie that was made about him and, you know, the instant billionaire kind of thing with a simple idea. Yeah. Things are, you know, it just 99.99999% of the time they don't work that way. And it takes a long time and a lot of hard work, and it takes sound management. What does Janine say?
Managers must manage.
Managers must manage, and you must have the proper financing mechanisms in place. So assuming that all of that is there and you've created a sustainable enterprise, then what do you do? And I shared with you this week an email I got from a friend of mine, very, very successful developer. They're probably in the 10 largest in the country. And they came to me with a proposition to help them finance several of their different projects. And this is a really neat guy, by the way. I mean, when you meet him, you're going to love him. He is just he's energetic and he's charismatic, and he is very contagious. Okay, so his enthusiasm in the room is actually going to infect everybody in a very positive way.
Oh, cool.
So the first time I ever met him, I was really taken aback with him. I was very surprised they called, because my understanding is that they had several large players, which they did, but they were a little bit distracted with some of their other projects that they were already in, and so it leaves him in a position to need capital formation around all these 4 projects. And in that discussion, and they're all great projects, by the way. They're all fantastic. He said, and we've got an exit strategy, and we want to do one of 2 things. We can always go down, and this was a very nonchalant statement, we can always go down the path.
Uh-oh, here we go. Brace yourself.
Brace yourself, everybody.
There's a meteor coming.
Yeah,
Right.
We can always go down the path of backing into a public shell. Of course, it was like...
Right.
And, and then we can liquefy our stock in that manner. And the other is that one of the bigger players, is going to come along and buy us out. Well, in the real estate development business right now, that second suggestion is not likely to happen very soon, because all the other bigger developers are faced with the same challenges he is. And the first scenario, as you know, we've even done shows on this. The whole, and they're still out there. There are guys out there on the web, lawyers and intermediaries, that are still selling public shells, and they're still saying this is a viable way to raise money and liquefy your stock. Well, that strategy isn't going to work, and I can assure you, I can guarantee, it's one of the few times I'll issue a written guarantee that will not work, simply because executing the reverse merger is like falling off a log. I mean, it's easy to do.
Okay.
The mechanics of it are very straightforward, and there is a step-by-step cookbook on how you do that.
So that's why these guys think it's low-hanging fruit.
Yeah.
We'll just back into a shell.
Just back into a shell.
And we hear this a lot in the ecosystem.
Then you got to get the stock trading of this entity. So if you're in the pink sheets,
no volume.
Yeah. If you're in the pink sheets or you're a small cap bulletin board stock, it is just not. You're going to spend more time trying to get the stock trading and keep it trading than you will raising capital and you will doing the business of your business. And in today's marketplace, investors just aren't looking to buy that stuff.
Yeah, this is huge, because so many people are very enthusiastic. There's a lot of buzz around this whole reverse merger idea. And, but it's a clean company, all of that. You still have to promote the stock.
Saying that you have a clean shell is an oxymoron.
Right.
So I gave him an analogy, and I said, this is backing into a public shell is like building a cruise ship out of styrofoam. It's going to look good and it'll probably float, but you'll never be able to board it.
Love that.
And so I hope he got the message about that. And I really wasn't being facetious. It's just that I don't want to have him waste his valuable energy, and he's a very creative guy. But I did see something the other day, the remnants of an exit strategy, which really caught my eye, and I hadn't seen it in a while. And this was an employee buyout, and there were some key players in the management side of the business and key players on the sales side of this business, and they put together a redemption agreement, or excuse me, an acquisition agreement with the owner of the business, and they wound up buying it in utilizing some very unique structures. As a result, the owner wound up coming out fully redeemed within 6 months.
Excellent.
And he kind of stayed on a consulting basis, but that proves the case that the business was a sustainable entity. And what do we always say? It's always about people anyway.
Right, exactly. Keep the people in the business.
Exactly.
He had an agenda in his own life. He's had a chapter in his life where he wants to remove himself from being so active, and also a liquidity event, right?
And this was it was a liquidity event for him. And this guy wasn't 70 years old. He was in his early 50s.
Good for him.
So it was a way that he could go on to the next chapter in his life.
This is a very viable exit, then, from your perspective.
And the way it was done, it was very meticulous. They really did dot their I's and cross their T's in the structure, and it worked. I saw another method which I thought was rather unique.
Yeah.
And this one involved actually being acquired by a public company, and the public company was one of this private company's biggest customers. Yeah. And so it was a way to vertically integrate. brilliant. And oftentimes I recommend that. I'll say, well, in fact, one of my best friends is trying to sell his business right now, and he was going to a business broker, and the business broker, did this valuation, and I read it and lost knowledge. And then I said, Ian, why don't you just go to your customers? And all of a sudden, you could just see that
the light bulb go on.
Well, and he did, and he's making progress on that front.
I mean, it's true. A lot of times, business owners don't think about this. It may just be maybe right down the block. Your buyer might be down the block or 3 degrees away from you, or even already someone you're working with, as in the case of a customer.
And I think I told you this. I've told this story hundreds of times. I lost a bet when Bill Clinton was first elected to office. That's right.
He had long hair once, guys. And by the way, I had hair once. Right, please continue.
And the bet was that Bill Clinton would not be elected president. And if he was, that I had to wear a ponytail for the duration of his presidency, which, as we know, lasted 8 years. And so, fortunately at the time, ponytails were in style. So that's the backstory to this story, and that was that my client was in the schmata business, and he was always the smaller player between him and this other guy. Yeah. The owner of the other business was a member of the same country club, and they, but the bigger guy's wife always drove the new Mercedes every year, and the other guy's wife had to get one every 3 or 4 years, and there was always a lot of that sort of social competition. Well, my guy had made a series of very, very intelligent moves in the business, and as a result, he wound up acquiring some designers and became even larger. And so the day came when he said to me, we want to buy this guy out and just take him out, insofar as competition, as well as there's some assets in there that we can deploy that will make a lot of sense. So the David and Goliath scenario. Yeah. So there all of us were for about a week sitting around a table, lawyers, bankers, and all but one person in that room had a ponytail. And so the end of the story is that the exit strategy was for the big guy. And once my guy completed the acquisition of the bigger then he was the bigger guy, then became the smaller guy, then my guy became the bigger guy, bought him, then another very large apparel company, not 6 months later, came in and bought him out. Wow. And so he exited. So there was kind of like 1 domino, 2 domino, 3 domino.
Well, this is interesting, where you have these fish eating the small fish and the large fish. I mean, there are, what is it? It's cycles in different business development where it's just the right thing for them to do, to acquire an asset. That's timing. Yeah, it's timing, isn't it?
Some of it's purely timing. But I can tell you, in the case of the employee buyout, that was really very well done.
You mentioned structure. There was something. Well, can you kind of put a box around what it was about the structure that impressed you? It
was their approach to valuation and how they converted that valuation into a very cogent flow of how they were buying this guy out. It was very methodical. There were certain things that were purchased, and thus a transfer of title occurred in sort of a succession.
In a sequence of some kind, yeah.
Okay. And it sort of matched. It was very meticulously matched to the financing. So and the end result was what everybody expected, and the seller was very flexible in allowing it to happen the way it happened.
Nice.
So there was one thing. Now, I will tell you about a client a few years ago that was bought out by a public company, and this was a very difficult structure because it involved taking so much paper in the company that he was being bought by. And so my only caution during that period was, okay, well, we really need to do due diligence on this company, and I better talk to some of my buddies who are analysts to find out what they really think of this. What is the skinny on the street about the stability of not only the company but the stock as well?
Absolutely.
And so there was a lot of peeling of the layers back. And we were able to ascertain what we believed was the real value of the stock in the worst case scenario, because you never want to take all that paper without knowing, if there's a cliff on its value that it's about ready to step off.
Yep.
And so we went to them and we said, look, here's the data we've got. Here are the analyst reports we've put together. This is what we're pegging the real value at. We're willing to take so much paper, but the flip side is it's not at market value. And that took some mechanics as it relates to the regulations with the Securities and Exchange Commission. But the net end result was that they did buy off on that, and we took about 90% paper. Now 90%.
So you validated the public company.
Yeah, but at our price.
Yeah.
And then there, it was sort of like a Pac-Man thing. A group of shareholders got together from the outside and then went after the company. And so it shot the value of the stock up. And so he came out like he was so happy. But again, it's something we were predicting the worst case. We had no idea
that this upside was going to happen from these investors from the outside.
Didn't have a single idea about it. It happened sometime later, but he was very, very happy with that. So those are a couple of methods that are being acquired by a public company, employee buyout. Also looking down the path of providing the financing for the entity or the individual that's interested in buying your business, carrying paper. That's another method as well, which is very popular, but you have to be careful about that. I mean, again, you better be selling it to a guy that can really manage.
Right.
You don't want to give it to some schlep that comes in and taints your business, and then you've got to take it back. So it better be with somebody that can talk the talk.
Back to the people factor. www.bhcapitalltd.com. As always, visiting with George Lovato Jr.
Another good show.
You have many titles. He's also just a
you're the author
good guy.
Of all these titles, for crying out loud.
Oh my goodness! And there wouldn't be titles if it weren't for you.
Hey, listen, I've got a title for you, Co-Dude.
We'll see you next time. You'll be the 2,000,001th viewer of Just Ask George. We'll see you then.
Thanks a lot for watching. Bye-bye.
For more information about George Lovato Jr. and BH Capital, visit bhcapitalltd.com. Check out more episodes of Just Ask George at justaskgeorgeradio.com. Just Ask George is produced by Steve Garth and is a production of BH Capital Ltd. All rights reserved.